George Soros has said that it's not whether you are right or wrong that's important, but how much money you make when you are right and how much money you lose when you are wrong. Hello and welcome back to Exploring Finance with Prashant. I am thrilled to have you here as we continue our exciting journey in the world of financial shenanigans. In the previous episode, we have discussed how key metrics and its surrogates can be used by management. In this episode, we are going to discuss four methods that struggling companies might employ to convince investors that they are not only doing well, but they are in excellent shape. Let's go to the first technique, manipulating the accounts receivable number to conceal the revenue challenges. Corporate leaders are aware that investors closely scrutinize working capital trends as indicators of potential issues with earnings quality or operational performance. They understand that a significant increase in the accounts receivable that doesn't align with the sale can raise doubts about sustainability of the recent revenue growth. To prevent such questions from arising, companies may resort to manipulating their accounts receivable figures through various means, including selling the receivables, converting them into note receivables, and relocating them within the balance sheet. In the previous episode, we discussed how selling accounts receivable can be seen as a helpful short term cash management tactic, but it is not a sustainable method for long term cash flow growth. It can also serve to lower the reported days sales outstanding to investors, making it seem like investors are paying more quickly. Unscrupulous management can hide an increase in the DSO by selling more accounts receivables. For instance, let's visit the case of Sanmina SCI, which quietly sold the receivables. After this sale, the company showcased a decrease in the DSO, an increase in cash flow from operations in its September 2005 quarterly results. Savvy investors would have realized that the drop in the DSO and the rise in the cash flow were due to selling the receivables, not genuine operational improvement. They understand that selling receivables is essentially a financing decision, where the cash owed by customers is collected earlier, naturally leading to a smaller DSO figure. Additionally, recall Peregrine, which recorded fictitious revenue and then deceitfully fabricated the sale of related bogus accounts receivable to avoid suspicion. These unreceived payments would have caused the accounts balances to swell, and the DSO to rise indefinitely, which could have been alarmed the investors. By faking the sale of these receivables, Peregrine inflated its CFFO and eliminated the potential DSO red flag all at once. In the past, companies have lowered their receivables to improve the DSO either by selling them outright or by falsely claiming to have sold them. Another tactic is to simply reclassify the receivables to another part of the balance sheet to conceal them. Symbol technology had experienced rapid growth in its receivables due to aggressive revenue recognition and channel stuffing, causing the days sales outstanding, that is the DSO, to increase to 119 days in June 2001, up from 94 days in March 2001 and 80 in June 2000. To avoid alarming investors, management executed a rather deceptive tactic. Symbol approached some of its loyal customers and requested them to sign documents that would convert their trade accounts receivable to promissory notes or loans. Evidently, the customer agreed because they still owed money in either case, and however, their paperwork allowed Symbol to conveniently shift these accounts receivable to the notes receivable section of the balance sheet. Efficiently, Symbol used this method to reclassify these trades receivables to an account that wasn't as closely monitored as by investors. This move seemed intended to lower the DSO and mislead the investors into thinking that sales were legitimate and the customers were paying on time, and it achieved its goal as DSO dropped from 119 days to 90 days in the following period. In 2004, UT Starcom employed a similar strategy by accepting more payments in the form of bank notes and commercial notes. Rather than classifying these notes receivable as accounts receivable on the balance sheet, the bank notes were even considered a subset of cash. The company presented a more favorable DSO to investors. Despite a significant decline in the business performance, vigilant investors could have spotted this improper account classification by reading the UT Starcom's footnotes. The company explicitly disclosed the acceptance of the substantial amount of bank and commercial notes in the lieu of accounts receivables. Investors received another warning sign on the UTR Starcom's balance sheet as the note receivable surged from $100 million in December 2003 to $43 million in the following quarter. It's crucial to identify the reason behind such changes. If management cannot provide a reasonable explanation, it could suggest that the company is manipulating the receivables to conceal the high DSO. Taleb's Inc., telecommunication company, altered its DSO calculation from using the end receivables to quarterly accounts receivables. This change made DSO seem better than it actually was. So it basically tried to change the formula of the DSO. But wait, what is the formula of DSO? DSO's formula is closing receivables into number of days in a period. DSO is not a standard metric. This formula is suggested by the book. Here are the learnings from this first technique. First, astute investors should note a change in the calculation of DSO. When management changes how it computes operational metrics, it is often attempting to hide some deterioration from investors. Second, investors should be concerned when they see a large decrease in the DSO, particularly following a period of rapidly rising DSO, as they are when they see a substantial increase in the DSO. Third, to calculate the DSO on an apples to apple basis, simply add back the sold receivables that remain outstanding at the end of the quarter for all periods. Fourth, whenever you spot a CFFO boost from the sale of receivables, also realize that by definition the company's DSO will have been lowered as well. Let's move to the second technique, manipulating the inventory metrics to conceal the profitability issues. Companies sometimes resort to manipulative practices concerning their inventory metrics in order to conceal the underlying profitability problems. An unexpected increase in inventory is often seen as a warning sign by the investors. Now, indicating that the potential margin pressure or decreasing demand for products. To avoid these negative perceptions and maintain investor confidence, certain companies employ various strategies. Let me tell you about some of them. First, inventory reduction plan. One example of this is Symbol Technologies, which had previously overstated its sales and faced an increasing number of product returns. To address this, Symbol created an inventory reduction plan. This plan involved recording the fictitious accounts receivable to reduce the inventory levels, leaving products on the receiving docks without including them as inventory, and selling inventory to a third party with an agreement to repurchase it later. Reclassification of inventory. Some companies choose to reclassify their inventory to different sections of the balance sheet. For example, Merck and Company began reporting a portion of its inventory as a long-term asset, categorizing it under other assets on the balance sheet. These inventories were associated with the products not expected to be sold within 1 year. Any sudden increase in the long-term inventory figures should also be a cause for concern among investors. The third one is caution regarding new metrics. In situations where inventory levels are inflated, companies may introduce new metrics to divert the investor concerns. Twin Brands Inc., for example, experienced a significant increase in the inventory levels. To address this, the company introduced a new metric called as in-store inventory per square foot. This metric excluded inventory not currently on the store shelves and presented an inconsistent comparison with prior years. Diligent investors should exercise caution when evaluating the usefulness of such newly introduced metrics, especially during the periods of inventory increases, and should critically assess the explanations provided by the company. So here are the learnings from this technique. First, transparency is very vital. The case of symbol technologies demonstrate the critical importance of transparency. When the company resorts to fictitious accounting entries, leaving the products unrecorded, or engaging in agreements to repurchase inventory, it raises red flags for investors. Diligent investors should scrutinize the financial statements for transparency and scrutiny, especially when inventory related issues are suspected. Second, evaluating the metrics with care. The example of twin brands, including a new metric in-store inventory per square foot, highlight the need for investors to exercise caution when evaluating the non-standard metrics. Inflated inventory levels can lead to the introduction of such metrics to downplay concerns. Investors should critically assess the relevance and accuracy of these metrics, relying on established financial indicators and conducting thorough due diligence to understand a company's true financial health. Let's move to the third technique, manipulating the financial asset metrics to conceal the impairment issues. Financial institutions heavily rely on the financial assets like loans, investments, securities for income. Therefore, evaluating the quality and the strength of these assets is crucial when assessing the future performance of banks and financial companies. It's essential for investors to know whether a financial institution's portfolio includes risky or illiquid securities or whether its loans are primarily issued to subprime borrowers. Consider two identical banks, differing only in their loan portfolio. One bank's portfolio comprises entirely subprime loan with 20% of them facing payment issues. The other bank lends to prime borrowers with only 2% facing payment delays. It's evident that the second bank will have more stable performance while the first one will experience greater volatility. In the case of New Century Financial Co., once the largest independent non-prime lender in the US, serves as an illustration of how financial institutions can manipulate the financial asset metrics to hide the problems. In April 2007, New Century declared bankruptcy due to its risky mortgage lending practices. One notable instance which involved New Century's actions in September 2006. Instead of increasing its loan loss reserve despite facing higher delinquencies and bad loan, the company reduced it to sustain the earnings. However, when New Century released its 2006 reports, it was less than a fortnight with investors regarding its reserve level. The company realized that investors would be alarmed if they knew that the reserves were reduced while its subprime loan portfolio was deteriorating, and this reduction was the main driver of the earnings. To conceal this fact, New Century modified its reserve presentation. Previously, the earning release had displayed the loan loss reserve separately. However, in September 2006, company combined it with another reserve allowance for real estate owned. and presented the two as a single unit. By doing this, New Century could claim that the reserves had increased, but the key metric that investors had been focusing on, the loan loss reserve, had actually declined significantly. This maneuver allowed the company to avoid signaling a deterioration in the asset quality while reporting the higher earnings. This presentation change likely bought New Century some time before its eventual bankruptcy. Investors who closely monitored both the levels of loan loss reserve and presentation would have received a warning of the company's impending demise. Those who missed the presentation change but reviewed the subsequent 10Q report would have seen the disaggregated loan loss reserve and been alerted to potential issues. Ultimately, New Century's executives faced charges of securities fraud in 2009 from the SEC for misleading investors and trying to present the company as performing better than it actually was. Here is the learning from this technique. The manipulation of metrics to hide the problems not only erodes trust, but it can also lead to significant financial repercussions, as demonstrated by New Century's bankruptcy and subsequent charges of the securities fraud. Let's move to the fourth technique, manipulating debt metrics to conceal liquidity issues. A company's cash obligations, particularly those related to debt payments, can significantly influence its future operating performance. When a company faces substantial near term debt obligations, it may encounter challenges in financing its intended growth strategies. In most severe cases, excessive debt and impending payments could push the company towards bankruptcy. It underscores the importance of effective cash management and prudent financial planning to ensure a company's financial stability and ability to support its growth objectives. Parmalat Finanziaria SPA, an Italian based dairy producer and one of the world's largest packaged food companies, expanded rapidly in the 1990s through aggressive acquisitions of food service companies globally. To fund this expansion, Parmalat heavily relied on debt, borrowing at least $7 billion through various offerings between 1998 and 2003. However, as the company faced financial difficulties, it struggled to generate enough cash to meet its debt obligation. Compounding on the problem, top executives of the family owned and family dominated company diverted substantial sum of money to other family businesses. Consequently, when Parmalat's bonds came due, it desperately needed to issue new bonds and equity offerings to raise the sufficient cash to pay off its older debt. Parmalat, seeking investors, engaged in fraudulent schemes to hide its massive debt and poor asset quality. By manipulating its financial statements, it presented a false image of strength, of financial strength. Prior to the fraud's exposure in September 2003, Parmalat concealed 7.9 billion euros in debt and overstating its net worth by 13.3 billion euros. There were warning signs for vigilant investors to detect, particularly in the late October 2003 when Parmalat's auditors, Deloitte and Touche, expressed concerns about transactions involving an investment fund named Epicurum, which was later revealed as one of the fraudulent offshore entities. These transactions were significant and accounted for the most of the Parmalat's pre-tax earnings in the first half of 2003. Despite Deloitte's concerns, Parmalat had not previously disclosed these gains in its June 2003 earnings release. In early November 2003, Parmalat publicly disputed Deloitte's concerns about the Epicurum transaction through a series of press releases. This public disagreement with the auditor, especially on a transaction of dubious nature, should have raised red flags. However, it took several weeks for Parmala's stock price to plummet as the company defaulted on its debt, ultimately leading to its downfall. The key lesson for us from this is the importance of being alert to the warning signs, such as the public disputes between a company and its auditors, and conducting thorough due diligence to assess a company's financial health and transparency accurately. Thanks for listening to this episode. Throughout this episode, we have uncovered the deceptive techniques that struggling companies employ to mask their financial challenges. These tactics include manipulating the various metrics from accounts receivable to inventory, financial assets, and debt. The overarching lesson is clear. By recognizing the warning signs and practicing due diligence, they can better safeguard their investments. We can better safeguard our investments and navigate the complex terrain of financial markets. In the next episode, we'll venture into the world of acquisitive companies and unravel the intricate accounting tactics commonly used in their strategies. Until then, keep questioning, keep learning, and keep exploring the captivating world of finance. Thank you. Have a nice day.